If you're familiar with the comedian Stephen Wright, he has a little different view of things. He talked once about going to a diner where there's a sign that says, breakfast served at any time, so he decided he could order French toast during the Renaissance. I'm sorry we don't have any French toast for you this morning, but we do have two panelists who actually are very deserving of the title of Renaissance thinkers when it comes to markets and investments, because they bring a truly unique and interdisciplinary approach to today's topic, which is innovation and markets. Sitting next to me is Michael Mauboussin, who is the managing director at Credit Suisse First Boston, where he is chief U.S. investment strategist and co-chair of the Investment Policy Committee. He's also on the board of trustees at the Santa Fe Institute, which is a leading center for multidisciplinary research in complex systems theory. And we also have with us Dick Hokanson, who is the director of demographic research at Credit Suisse First Boston, where he's responsible for analysis and forecasting of global demographic trends and their associated economic and investment implications. He's also one of the trustees of the Population Reference Bureau in Washington. So let me turn it over first to Michael Mauboussin, and we'll get underway.
Thank you, Ron, and good morning to everybody. Certainly a thrill to be here, and I'm really, really pleased to work with my colleague Dick, who's watched his work for a lot of years from an arm's length, and now to be working with him side by side is a real thrill. I think this morning we're going to talk about two themes, or sub-themes perhaps, that underlie a lot of our investing work, and we're going to really try to bring those to the surface and think and talk a lot about them. The first is the idea of innovation and what it means for investors, and the second is demographics. On innovation, I'd like to talk about three major thrusts. First is just hit on the evidence for accelerating innovation in the marketplace today. And I'm going to just touch on a handful of pieces of evidence of why innovation is not only happening but accelerating. Second, spend a few moments on some models of innovation, from the very large, where we're going to use some biological analogies, down to a much more micro level, where we can talk about innovation at a company level or an industry level. And I'm hopeful at the end of that discussion we'll see that the case is not only for continuing innovation, but again for accelerating innovation. And then finally, we'll talk about what this means for us as investors. If these scenarios are valid, do we have to think about our jobs differently? Do we have to organize ourselves differently to take advantage of that? So let me go, and by the way, I don't know how to tie into Temptation Island. I was trying to think of, I'm lost on that one. So.
Try the poster behind it.
Yeah, exactly. Good thing I'm not looking at my posters, yeah. So let me talk about some cases for accelerating innovation. And again, there's just a few things that I'll run through relatively quickly. The first is what I call the shortening of long waves. Joseph Schumpeter is a very famous economist, best known for his line, The Creative Gale of Destruction. But in 1939, he wrote a fairly important book about so-called business waves, economic long waves. And in that book, he basically said there are these things called economic long waves. And what happens is a general-purpose technology comes along, electric power, steel, what have you, and that creates itself a set of industries and industries around those industries that create an economic boom, takes off for a while, and then it slows down on the back end. So you get this wave of growth. And in that book in 1939, he documented the occurrence of these waves. Pretty well established. Well, now with 60 years of history behind us, what we see is not only do those waves exist, but they're coming at a faster and faster rate. So the time between starting and finishing of these waves is actually quickening. Clearly, the most recent one is something related to the Internet. Undoubtedly, we'll have continued waves. And what this means, of course, pragmatically, is that industry life cycles and product life cycles are shortening, which has direct implications for our time horizons and thinking about time horizons as investors. Another thing that feeds onto that, the second point, is on what I call corporate longevity. One very crude measure, but an interesting measure, is additions and deletions in the S&P 500. So what is the average expected life for a company in the S&P 500? As it turns out, in the 1950s, that expected life was about 25 or 30 years. In the 1990s, because of additions and deletions, that dropped down to about 12 to 14 years. And if you take the 2000 data, and albeit it's one data point, but you extrapolate what we had in 2000 over 55 changes, the corporate life is down to 8 to 9 years. So again, playing on the averages, if you go into the S&P, you're expected to stay there on average now less than 10 years. And again, a lot of that's mergers and acquisitions activity, but as well, it's companies being swept out that are effectively fallen angels. The third point, I think, is one that I find to be absolutely fascinating, and this probably has the most reverberations for all of us as investors. There's going to be an article out in the Journal of Finance in February, but you can access the article now by John Campbell, who's a terrific economist at Harvard, and Burt Malkiel and some other colleagues. And they basically looked at volatility. And what they found was, if you look at, they went from 1960 to the current period, and what they basically found is if you looked at market volatility, it bounces around, but basically we've been in a relatively stable channel for the last 40 years. However, if you look at firm-specific volatility, it's been on a steady upward trend over the last 40 years. So there's aggregate stability, but local instability. And one way you might picture that is you go to a Broadway show, the same show appears every night that you go, but the people playing the different roles, the cast members, are changing. Global stability, local instability. Now you sort of say, well, how can this thing sort of go together? Well, number one, the major implication is the correlation between stocks has dropped. The second point they make, and I think worth stressing, is the increase in volatility on a company-specific level is not a function of financial leverage. They actually looked at that and basically ruled that out. And the third direct implication is we've all learned in our sort of diverse modern portfolio theory and diversification that if you had about 20, 30 stocks, you got rid of about 85% of your idiosyncratic risk. What these data are suggesting is that rule of thumb no longer applies. And diversification may have to go to 50 or 60 names to extinguish the same amount of idiosyncratic risk. So aggregates volatility stable, firm level volatility on the rise. And I think this has a lot to do with picking winners and losers. The next evidence, and I'm going to actually show you a graphic on this, but the next evidence is the increased incidence of winner-take-all markets. And here's the backdrop for that. I think it's relatively clear-cut and observable that the global economy is evolving from one more based on physical capital to one based on, quote-unquote, knowledge capital. And one of the key characteristics of knowledge capital, or these kinds of businesses, are so-called network effects, where the value of a good or service increases as more people use that good or service. Think very simple examples like eBay, or AOL, or Enron in terms of some of their trading markets. Well, as it turns out, in network formation, these tend to be winner-take-most markets. That is, there tends to be one dominant network for a given space, and the rewards for coming in number 2 or number 3 are relatively moderate. So you get this sort of winner-take-most or winner-take-all outcomes. One of the things we did is we took a look at the performance of the S&P 500 by sector. We tracked the performance of the top 3 companies, total shareholder returns, and the bottom 3 companies. And what we found from the mid-1990s is a trend that looks just like this, which is to say the best companies are doing better and the worst companies are doing worse. So from a portfolio manager's perspective, that says the winnings, the spoils for getting it right are increasing, and the costs of getting it wrong are becoming greater. Winner-take-all outcomes. We think this is a signature of knowledge-based industries, and we believe this is something that will perpetuate. And incidentally, I keep talking about knowledge-based, and I gave examples of things like eBay and AOL, but let me be very clear that even, quote-unquote, traditional businesses can capture these winner-take-all or network effects. And I think a good example is a company right up the street is General Electric, where in certain of their businesses they're taking their strong physical base, fortifying with a strong service base, and then moving into networks and really building market shares and a formidable network that will be hard to topple and increase their returns. This is the last point I'll make on this section, and more than evidence, I think this is just almost an observation or perhaps even an assertion. First principles of valuation tell you that three things dictate an asset value. First thing is cash flow streams. Second is some sort of discount rate, cost of capital. And the third thing is the period of sustainable competitive advantage. The longer a company sustains its advantage, higher its valuation, the shorter its period of excess returns, the shorter the advantage. And here's the basic point or assertion that we would make. In the world as it was, you had companies that had relatively modest excess returns, think return on equity or return on capital, but they were able to do it for a fairly long period of time. Right? So modest returns, but they can do it for a long time. And what we're seeing in the quote-unquote new economy is companies that are generating huge excess returns, but because of obsolescence, they can do it for only a relatively short period of time. So modest returns for a long time versus huge returns for a short period of time. And if you want a way to visualize that, think Microsoft versus Coke, right? Coke does it day in, day out, very good economics. They have good years and bad years, but good economics, stable. And I think we'd all agree if we reconvene here 30 years from now, Coke would be probably doing what they're doing in some recognizable form. When you look at Microsoft, by our reckoning, Microsoft earned returns on capital, if this is even a meaningful sum, of 700% in fiscal 2000. It's inconceivable. But as we all know, Microsoft's dominance in their core business, PCOS, is probably going away. I think we'd all agree that if we reconvene 30 years, there would be no such thing, or certainly nothing that we would recognize. So unbelievable economics for a short time, modest economics for a long period of time. So one of the major repercussions, I'll go through this very quickly, is we think that traditional measures are becoming less useful. The nature of investment is changing. Versus capital, people used to capitalize their investments, now they expense them. It used to be factories, now it's R&D. Employee stock options. In knowledge-based businesses, employees want upside. That upside has to be captured in our valuation. Very few people are doing that successfully. Option value. I'm talking about real options in the organization. Greater uncertainty lends itself to options analysis. We think these are very vital tools. That has to be more in our positioning. Risk we have to think more about in the notion of competitive advantage. So with that, let me move on to the second part, some models of innovation. And I'll try to go very briskly through this, but there are four levels, and I'm going to go from the very big to the very small. The first, very big, is a straightforward biological analogy, and I'm going to harken back to the Cambrian explosion. Happened about 550 or 560 million years ago, and there's a term in biology called adaptive radiation, which basically means if you open up an ecological niche, what happens is the species will go in there and fill it very quickly, and sometimes there'll be a proliferation of species, and then what happens subsequently, not surprisingly, there's a major collapse. As Darwinian evolution works, the weak ones die and the strong ones succeed. So we see this direct analogy to the business world. So ecological opportunity is an economic opportunity, again, generally spawned by general purpose technology. In biological worlds, you have differential populations. So what that means in our business worlds, we create different categories. And what you see in the ecological world is ecological differentiation. Within a category, species segment themselves, and we see, of course, within categories, companies segment themselves. But again, the point is, in the Cambrian, we saw a massive increase in speciation followed by a massive extinction. And I think that's precisely what we've seen today. Interestingly, there's a book that's been out for some time, which I'd recommend if you're thinking about innovation, by James Utterback, called Mastering the Dynamics of Innovation. The reason this is useful, especially given what we've gone through in the past 24 months, is he documents innovations in industry after industry where we see the same pattern. Huge increase in number of companies, huge extinction. Increase in companies, extinction. I have here a chart of the automobile industry. There have been, in the United States, over 2,000 at the peak automobile producers in the U.S. Went right up, it came straight down. So typewriter industry, TV manufacturing industry, radio industry, take one after the other, same pattern. So everyone says the Internet was the biggest mania of all time. The answer is absolutely, because it's the biggest phenomenon of all time. But we've seen this pattern repeated over and over. And incidentally, a last quick sidebar on that, there's an interesting piece in the most recent Journal of Applied Corporate Finance. This happened, of course, in the disk drive industry in the 1970s and early 1980s. Venture capitalists were throwing money at the industry, beautiful IPO events, people were making tons of money. The whole thing crashed. And so there's a paper written in 1985 by two Harvard professors, and they said, capital markets stink. Right? We get this huge, we're whipsawing. Doesn't make any sense. And they've written right on the heels of all this, the downside, the carnage. Well, these two professors picked up in 1985 and took it to 2000. What they found was the companies that made it through the carnage were actually very good stocks to own. So I think that's a mindset that's very valuable at this point. Second major model is endogenous growth theory. And I won't spend much time on this, but the leading, I think, advocate for this is Paul Romer. The basic idea is economic growth is a function of labor, capital, physical capital, and knowledge, or software, that layers on there, technology. And for years and years, the economists had a hard time making that endogenous to the model. Now there have been worked out ways to do that. But I think the key idea is if knowledge is the key to incremental growth, and I truly believe it is, knowledge is a non-rival good, unlike physical or human capital, which is a scarce resource. So once you come up with a clever idea, once you map the human genome, this is information that's valuable that can be used by many, many people without any congestion. Unlike coming up with a machine that every time you need to use a machine, you have to replicate it. So the distinction between rival and non-rival, I think, is quite vital. The other thing is I just have some fun facts, which I'll read off very quickly, but I think these are always very interesting. Moore's Law, everybody knows about this. But contemplate this point for a moment. The leading scientists now are suggesting Moore's Law will continue to the year 2030. It'll probably be propagated by quantum computing or some nanotechnology or something. If that's valid, that means the computer you have at your desk will be either 1 million times more powerful for the cost, or it will cost 1/millionth what it costs today. This is literally inconceivable for us as humans. You cannot conceive what 1 million times of computing power is in 30 years. God willing, that'll be all of our lifetimes. Gilder's Law. Bandwidth growth is 3 times faster than computing power. Here's a George Gilder fun fact. More information can be sent over a single cable in a second today than over the entire Internet in 1 month in 1997. Just to give you the sense of the progress. And the last thing is information storage, and feel free to use this at cocktail parties over the weekend. Over the next 2.5 years, and this is done by some professors at Cal Berkeley, it's estimated that more information will be produced than was created since the dawn of civilization. So these experts believe that in the next 2.5 years, more information will be produced than the dawn of civilization roughly 40,000 years ago. These are staggering numbers if you think about them for a moment. Third level of innovation is a national level. Michael Porter, who's well known for his value chains and 5 forces work, has recently done some outstanding work on competitiveness on a national level, and they highlight a few factors that speak to that. I'll just leave you with this point. It's a very good framework. They found that there is convergence of the OECD countries. That while the U.S. remains ahead in terms of this innovation capacity, there has been some convergence, which is something to keep in mind. The final and last model is one that's been popularized by Clay Christensen, professor up at Harvard Business School, called the innovator's dilemma. And I think this is worth thinking about and revisiting periodically as well. And Christensen's work is based on 3 points. The first is there's the difference between a sustaining and a disruptive technology. A sustaining technology is a technology that improves what's going on already, but does it basically within the same value network. It sort of does it the same way. It's better. It could be radical, but it's in the same value network. A disruptive technology fundamentally comes at the problem in a different way. Totally different way. So one example that would be pretty good would be the book retailing business, right? Barnes & Noble and Borders were doing superstores. Really terrific. So you have lots of parking, open lots of hours. You get cafe latte and walk around. Great. It's a great experience. That's a sustaining technology. Amazon.com is a disruptive technology. They're giving you a similar end result, but a totally different experience and a totally different value network. Now, whether it works or not remains to be seen. But that's one distinction. Number 2 is technology has advanced faster than market demand. So eventually, the technologies get too good for what the market demands, and then consumers decide they want to reshift their emphasis. So rather than just getting an automobile, you want the right color, the right time. Rather than just getting a PC, you want it customized and so on and so forth. Changes the industry. And the third point is that passing on disruptive technologies is often consistent with everything the management textbooks say. So management textbooks say, talk to your customer. And your customer said, you say, do you want this new disruptive technology? And they go, no, never heard of it. No, don't bother me. And they say, only do net present value projects. And guess what? No one knows what the markets are or what have you. So often managers that pay attention to what they're supposed to do are the ones that get literally blindsided. So it suggests we should have much more of an options mindset. So innovation's accelerating. The models that we look at suggest it's going to continue, and there are ways to think it through. What do we do about all that? I think there are three general steps, and I'll give you some more specifics. The first is reassess this concept of diversification. I think that's straightforward. Second is update valuation tools. The PE multiple has always been this, or been this historical range, is becoming much, much less valid. And incidentally, things like historical multiples are really great until you really need them. Because when there's a fundamental shift in what's going on in the underlying economics of businesses, that's when those multiples don't tell you the answer. And also, I do believe things like options theory, not just because of employee stock options, but also because of real options, will become more and more commonplace. And then finally, I think we do have to update our mental models. And in particular, I call them the early detection systems. You have to be able to figure out who's going to win and who's losing. As a good friend of mine calls it, when do those big technology companies go to the dark side? So here are the specific recommendations. There are three. The first is what I call avoid the twilight, which is to say, especially in technology land, very often if the CEO's mug is on the cover of all the big business magazines and they're heralded as being the top of their game, it's typically when they're the most vulnerable. Because that's when they're not paying attention to general purpose, the disruptive technologies, or they physically cannot do what they've always done successfully. And I'm not going to make any stock calls or stock recommendations, but I will make this observation. I was on a panel or a conference along with John Chambers from Cisco. This is just September. And he's wonderful. I mean, just love to listen to the guy talk. It's very exciting. And he says, oh, by the way, we have 34,000 employees. Oh, by the way, we have to hire 17,000 people in the next year just to meet this year's growth forecast. And I'm thinking, 17,000 on 34,000? That's a pretty good job. To meet this year's growth target. And by the way, the guy's walking around with a $500 billion market cap, which means the market may be looking beyond just this year. So the physical things a lot of these companies have to execute are relatively aggressive. The second point is find the future. Where are the emerging networks coming from? You know, and if you've been able to find an AOL early on or find an eBay early on, there was a lot of money to be made. But we know for sure that there will be a lot more of these in the future. And I think I'm going to probably get this roughly wrong, but I think of the top 15 market capitalization companies in the U.S. today, a third of those didn't exist 20 years ago. Didn't exist 20 years ago. So I think it would probably be reasonable to fast forward and say 10 or 15 years from now, a substantial percentage of the leading companies will not be companies that we know of today because they don't exist. And the last point is I call avoid innovation. It's my Warren Buffett line, which is as an investor, there may be opportunities to find industries or sectors where innovation is just not a big deal. If you're a hotel management company or you're a waste collector or a food, beverage, tobacco company, there may be opportunities where, and this is a lot of stuff that Buffett's doing today, he's buying carpet companies and paint companies. He's avoiding innovation, which if you buy things at the right price, that may be successful. So with that, I'll turn it right over to Dick.
Okay, so I got the segment on yuppies, vummies, dinks, oinks, moos, and Nikes. For those of you not up to speed on your demographic acronyms, vummies are very upwardly mobile mommies. Dinks, dual income, no kids. Oinks, one income, no kid. Moos stand for married only once. Rare species in Southern California. And, of course, Nikes are no-income kids with education. Be careful how you laugh at that one. Because some of them come back home to live with their parents as children, a group for obvious reasons sometimes referred to as baby boomerangers. But I'm not here to entertain you with interesting cocktail party chatter, but basically try to give you a perspective not just about the U.S., but about the world, principally sort of using the demographic prism And if you come away from this session with nothing else, it will hopefully be the recognition, the realization that you're making investment decisions in a world that is structurally and fundamentally different from the past. We have not been here before. And essentially what is changing the whole landscape is the decision of the group of people in the OECD world, the developed world, a group of people born essentially between 1945 and the early 60s, the post-war baby boom generation, whether it was here, Canada, Japan, or Europe. That generation has now made the unprecedented decision to voluntarily not replace themselves in the population pool, to have more brothers and sisters than children. And the whole annals of at least industrial economic history, if not of all history, we have never seen that kind of change take place, where a generation does not replace itself. So essentially what you have in the developed world is a situation of now population aging. But population aging doesn't just mean that there are more people who are old or older in some sense. It's also a decline in the number of people who are young. And that's having profound impacts on sort of industries and so on. I'll come back to that in a minute. The other important issue to recognize is that population growth rates globally are also slowing substantially. I don't know how many of you in this room remember a group called the Club of Rome. Right, 1967, they wrote a book called The Limits to Growth, which was essentially a kind of rehashed, kind of Malthusian approach, talking about populations exploding geometrically, food arithmetically, and forecasts of war, pestilence, starvation, etc. And whether they realize it or not, they have already won. In 1971, so 4 years after the publication of Limits to Growth, the global fertility rate peaked at 5 children per woman each. It's now below 3. And it's not just China. In almost every country in the world, birth rates have declined by 40-50% off those peaks. So you're not only in a situation where the OECD or the developed world is aging and growing more slowly, but you're also in a situation where population growth rates globally are slowing. Populations in the third world are growing faster than we are, but the rate at which they grow continues to slow. And the important conclusion out of that, then, is we either have one of two worlds coming ahead of us. Either we have a world of very sluggish global growth and a less kind of interesting investment environment, or you can flip that around, and that's basically the position that we take in the piece I left outside, which is to view this as the possibility of a wonderful global economic environment, but with substantially different drivers. If you think about it, how do economies grow? They grow in only one of three ways. Either there are more people, labor. Labor is worked more intensely, which means either low unemployment rate or change in average hours of work, or they are more productive or efficient. Labor force growth rates are slowing. Intensity issues for most countries is at maximums. So then basically the whole issue then becomes the basic conclusion has to be either economic growth over the next 20, 30 years is very sluggish, or it is very good, and it's very good because of very strong productivity. And that's essentially the position we've taken. That what we're seeing now with the microchip, the internet, and so on basically is kind of a replication of the Industrial Revolution, where not only growth accelerates, but it continues to accelerate, this whole sort of learning by doing, the important issue that Michael touched on in terms of technology as a non-rival good and so on. So we remain very optimistic then about the future in terms of not only global economic growth, but obviously it has major implications then in terms of the global demand for technology, in terms of raising output or raising capital per worker, not only here but in the third world as well. The most important investment-related conclusion that comes out of this is a world of very low inflation. If inflation is a stock, it's a short. Okay? If productivity is a stock, it's a long-term accumulate and buy. That's the single most important conclusion. And if you think about it, that's, I think, one of the most important things that investors have to decide on. What is happening to inflation, not just domestically, but globally as well, because inflation has the biggest issue not only in terms of where interest rates go, but also the whole issue about in terms of, do I want to own real assets, do I want to own financial assets, and so on. And the work that I've done in demographics, both domestically and globally, my continued message here is that inflation will continue to surprise on the downside. What that means, of course, for corporations is you will continue to destroy pricing power. Pricing power is just getting carved up globally. And it's interesting that we're here in Connecticut, because I think one of the first people that recognized that pricing power would be carved up globally was Jack Welch. 15 years ago, he came to the conclusion that pricing power was going to be destroyed globally, and rethought then how do you run GE in a world where you can't raise prices. I would say, for me, the single biggest distinction in the sense between quote-unquote old economy, new economy, is the attitude towards prices. Most companies in the new economy are constantly cutting prices. And it's the Cokes and the Pepsis of this world who think they can raise prices who continue to sort of get their head handed to them. What have we seen recently in response to the slowdown in terms of consumer demand and so on is more companies talking about having to cut prices to sustain demand. So pricing power, that's a very important conclusion. Pricing power here just gets continually destroyed in both a secular and in a cyclical fashion. So when you're looking at companies or thinking about companies or whatever in terms of how do they grow their top line, how do they grow their bottom line, and so on, they're typically not going to be doing it in a world where they can raise prices. Then the other big issue in terms of this whole shift, and that is, fewer young, more old. Here you want to focus on it from the point of view of, the baby boom is always the pig in the python. It's the hump, the lump. The pig has moved. Okay? And now you're going to think about, what are the industries the baby boom is moving out of? What are the industries that they're moving into? The biggest industry that they're moving out of is the consumption of goods. Here the big issue is in terms of what is fundamentally changing the drivers of global economic growth in the OECD world is that everybody's experiencing a decline in the number of people in their 20s. And what's very important about that 20 to 29-year-old age group is that's the age group at which people leave their parents' home where they share goods and services and then begin the whole household life cycle. All the people who go from 0 to 1. First household, first car, first job, and so on. That's the missing component. After that, you trade. It's very significant when you look at even the OECD world that the average person who lives in Germany, the U.S., or Japan does not own more than one house at a time, drive more than one car at a time, or work in more than one office at a time. So the average impact then that most of us in this room have on the growth rate of consumption or the growth rate of the economy is fairly minimal. It's the income of the trade. Your standard of living improves, your circumstances change, move from a smaller house to a somewhat bigger house, whatever. But the key issue is, the much, much bigger driver is going to that first house or apartment or whatever, and then having to furnish that and so on. And then after that, you sort of trade. In terms of the United States, that issue of this shift out shows up first in this region, the Northeast. You can think of the Northeast, in a sense, as the bellwether or the prototype for what does the U.S. look like over time in terms of this whole aging process. In the Northeast, we already have the Chapter 11 filings of Bradley's, Caldor's, James Way, Strawbridge and Clothier, Herman's for the second time, and more recently, Nobody Beats the Wiz. To me, those are not isolated random occurrences. They're at the heart of this whole change. Remember, we built this very large retail trade distribution system for the baby boom. Baby boom is not replacing itself. That means I have retail space I'll never need. The state that is at the other end of the spectrum, that is the most protected, the most buffeted from this, is Arizona. Arizona has the most positive demographics. They have huge inflows. Median age that is below the national average, despite all our impressions about Sun City and long yellow lights, because there's presumably lots of drivers with extended reaction times. I go to Phoenix a couple of times a year. Each time I go, I need a map. That's how much changing, right? That's how much growth changes and so on. So that doesn't mean there aren't opportunities within retailing, but it's a different set of opportunities than if the whole tide is rising. And then the other thing to focus on then are the industries that the baby boom is moving into. And here, I think the way you want to think about it is the whole sort of general concept of experiences. I've got my stuff. I have enough stuff. I've got TVs, I got VCRs, I got a car, I got a house, I got a vacation house, I got a boat, and my stuff's good enough. Met a guy in Texas who says, I probably have more shoes than I can wear out, kind of stuff. Your stuff's good enough. You're trading, you're getting some new things. But the real thrust is in terms of experiences, what are the things that I want to be doing? Oh, maybe I want to walk the Great Wall of China or go to a seminar or do something else. It includes services. It obviously includes things like financial services. It obviously includes things like health care. But again, the whole health care issue is baby boom is behaving differently with respect to health care in the following sense. The parents of the baby boom basically use pharmaceuticals to treat an existing condition. The baby boom basically is using pharmaceuticals or whatever to prevent the onset of the condition. There's a fundamental difference, a fundamental shift there in terms of mentality. So my guess would be that the average age at which people begin using pharmaceuticals and so on is probably dropping in some sense. You're still a long way away from, long demand and so on for assisted living and so on. But here's my important financial advice to you, personal financial advice to everyone in this room. Do not wait. Buy your retirement house today. And I'm serious. The aging of the American baby boom is the most predictable event of all time. It takes every market by surprise. No one builds supply in anticipation of the demand. The same thing will happen to prices for retirement homes as happened to prices for new homes in the 70s and 80s. The market will be simply overwhelmed by the number of people doing that. If you wait and then you're colliding with every other baby boomer doing the same thing, the prices get astronomical. So the only way, from a personal point of view, is to act in advance. You don't have to necessarily make a decision, I want to live in, retire in Phoenix or the Carolinas or Florida or whatever. But you just have to find a way to participate in that market so that when you do go and make that decision, you have already experienced some of the upside potential. The last point I'll make, and this has to do now with the interplay of the sizes of generations. The large baby boom and the smaller Generation X. What's now beginning to play itself out here and in the West is this interplay between the size of generations in the following context. And what's a common goal for each of us in this room? Common goal in some sense is to provide a better standard of living for our children than what we grew up with. Do better in some sense than our parents. The large baby boom shifted the supply curve of labor out, depressed its own price. Most baby boomers have had flat or falling, on an individual basis, flat or falling real wages for most of their life cycle. So the only way the average baby boomer then was able to accomplish the goal of a family or household standard of living that was better than his or her parents was to have more than one earner in the family. There wasn't much choice. The exact opposite is happening for Generation X. Supply curve labor is shifting in. Generation X has a rising real wage. But their real wage is not rising so much because their wages go up so fast. It's what those wages buy. The lowest home financing costs now in almost 2 generations, and flat to declining prices for consumer goods. I mean, that's where I have essentially lots of excess capacity. So Generation X then has the ability to make a choice. And what you're seeing happen is approximately 3 million Generation X families have voluntarily made the decision to go from 2 paychecks to 1. And that's a lot of the origin of no pricing power on a domestic scale. But the more important issue is what it's leading to in the retail world is the whole bifurcation of markets. It's the difficulties that Sears and Penny's and the department stores have. There is no middle. In retailing in general, I have sort of 2 groups of consumers. I have baby boomers with money. Never underestimate what baby boomers will pay for things. Okay? If you've got a 1982 Petrus, keep it. Okay? Because its price is going to be rising exponentially. They're doing their final trades in a sense. The kids have finally left the house. Now we can get good furniture. But make sure they left first, right? Or I have these Generation X on 1, not two paychecks. Those are households with more time than money. And they're trying to focus on how do I make that 1 paycheck stretch in a sense. And that's what shows up at the Targets and the Walmarts of this world. That's their demand in a sense. There is no middle. There's no constituency out there in a sense, or Sears or Penny's. There was actually a very interesting article on Sears in the front page of the Wall Street Journal, June of '99, I guess, to the effect about Sears having a very high appeal in the Hispanic community. And the way I read that article was not that there was an issue about ethnicity in terms of what Sears was selling, but the appeal to a traditional middle class. That's what we import. That's official U.S. immigration policy. We import a traditional middle class because we import from the regions of the world, the Americas and Asia and so on. And official U.S. immigration policy is family reunification, bringing in parents, grandparents, and so on. The problem, obviously, from Sears or Penny's point of view, is there are not enough of them. to make a substantial difference. But what you're seeing, in retail markets, it gets replicated in lots of different places. The whole squeeze on the middle. It's why there is no more DLJ, because we were in the middle. DLJ was in the middle. CSB, so there's this kind of combination. What shows up with financial service managers is very difficult to manage $30 to $50 billion. Either you're very small and you're nimble, or you are very big and you are very efficient. It's hard to be in the middle. That's where you see all these sort of consolidation changes and so on. So, bottom line conclusion here, change accelerates. It's one of the sense to tap into those underutilized labor resources in the emerging economies and so on. And it's going to be a great and very interesting ride. Thank you.
Any comments or questions? Actually, just wait one moment. Sorry.
No.
Use the microphone.
Every June, my father has a birthday, and this is a guy who's about 75 years old and has pretty much whatever he needs. And the question is, what do you get somebody who doesn't need anything? And the answer is a consumable thing, right? Something he can consume, like wine, for example, something that gets used up. So in addition to travel and information technology, communications and whatnot, I would think that things like so-called consumer staples would have a big market as
but better high-value consumer staples, right? A nice bottle of wine. Or that's what I asked my kids for.
Well, right. Not as a gift, but perhaps, but toothpaste, for example. Consumables. Things that.
Those are very mature markets. For most staples, they're very mature markets. What you can say within those categories, within food or within beverage or whatever, is there is this whole tilt towards the higher or better quality. People drinking good wines, eating good food, and so on. But, toothpaste, I don't think is going to cut the mustard here. Their growth opportunities are outside the OECD.
Are there any other?
Two questions, one for Mike and one for Dick. Mike, one of the things I happened to listen to yesterday with Solomon was Dick Thornburg from your company talking about the OJ Direct and whatnot. Is wealth management, as evidenced by Vencast and other places, a disruptive or sustaining technology? And how long is it going to take for people like Morgan, Goldman, et cetera, to get high-tech and high-touch together on this? And for Dick, sounds like you should be shorting Sears and going long Toll Brothers. However, you talked a lot about domestic demographics. Flip it. Internationally, middle class, Europe, do many retailers go that way, or the strategic consolidations going that way?
The same problem, the squeeze in the middle is also a Western European problem. It's called Marks and Spencer. Right? So this is not an issue that's unique to the U.S. because what you have throughout the Western world essentially is declining labor force participation rates for people in their 20s, mainly women. It's not replicated in the East. Japan, you have the opposite situation where you still have rising participation. I think part of the issue here is in the West, the principal caregiver or caretaker are women. It used to be that the average woman spent 20 years as the mother of a dependent child, but only 7 years as the daughter of a dependent parent. Now they're the same. It's 20 and 20. The whole part of the paradigm for baby boom women was delay. Delay marriage, delay childbearing. Those women now are the icing in the Oreo cookie. They're getting squeezed. They've still got kids at home, and now their parents need their help. In a sense, the way women unsqueeze themselves is to begin to have families at younger ages. And that's what you see happening in the West. The birth rate for married women in their early 20s is now rising for the first time in about 40 years. And essentially what women are saying is, I will now fold work around the family, lower home financing costs, make it possible to make that choice. So it's a phenomenon throughout the West that there's going to be this whole collapse of the middle.
I have no intelligent answer to your question. You admit that?
That's why I went first.
Exactly. I was formulating that, no answer. But, to me, I think the issue of wealth management is obviously extraordinarily important. And when we look out at the industries, and I think Dick sort of alluded to this, there's three industries that seem to be particularly interesting: technology, healthcare, and financial services, all global, all knowledge-based, all demographically sound, or there's some interesting underpinnings there. And I'll just, I think in financial services, especially for individuals, there's a huge amount that technology can bring to the table to improve the experience for most people as they go through their wealth management process. So my own suspicion is there will be a lot of change, and hopefully a lot of improvement in that area. So the term disruptive technology, I'm not sure, but certainly change, I think, is inevitably on the horizon.
But I would also add, there's also going to be lots of room for personal management. It's the whole sort of bifurcation. Either you're going to, in a certain sense, you get serviced by somebody who's really very efficient, but you deal with them on a network, you deal with them on an 800 number, or you want somebody that you can talk to. It's part of the to a certain extent, it's the challenge that Vanguard had. Well,
when you look at the lower portion of the mass affluent and wealthier than the 1 5, most people are looking and saying, what ought to build technology? They're not getting high touch. Those people are looking to develop.
That's right. Vanguard had to open an office in Phoenix because people get used to, going to their office in Malvern and asking questions and so on, and they move to Arizona and they get tired of dialing an 800 number. There is a group of people out there that want personal service or some semblance of personal service.
I'm curious what your take on not the advent, but the implosion of hedge funds might be. Do you see hedge funds as being a rival technology or a disruptive technology in the field of investment management?
For anyone. I would just say from my perspective, I think that hedge funds are a vehicle for a mechanism vehicle for some of the smartest people to go to work. So I think that it doesn't go away. And I would argue, I think if you take my arguments to an extreme, there's sort of two ways to go. Either you're going to completely go for active management, and a hedge fund format's one intelligent way to do that, or you're going to index. And probably, indexing makes a lot of sense for most people. But in this case, if this environment is true, then in other words, the stakes are going up. So that being right is going to be more valuable than being right. And I think what you're seeing is a natural reaction to a lot of this, and it has to do with a lot of incentive systems, especially in the mutual fund industry, is this phenomenon of closet indexing. Right, so if you don't know what the heck is going on, they're winner-take-all markets, what do? You say, I'll take my 75 basis points or 100 basis points closet index and go home, and that's it. Stay somewhere within, minimize my tracking error and call it a day. So I think the best folks, and you're seeing it, that's why all the smart people gravitate towards hedge funds. So I don't think it goes away. I don't think it's a disruptive technology, but I think it's the purview for folks that really have a sense of what's going on. Now, I'll tell you that I spend a lot of time talking to these people, and the level of conversation I have with the bright hedge fund people is radically different than the average mutual fund portfolio manager, that's for sure.
Mike, I had a question for you. You mentioned during your presentation the role of options, and I wonder if you'd elaborate a little bit more on the implications of that and what the demands of that phenomenon are in terms of security analysis.
Right. Well, there are two kinds of options, and one I'll dismiss quite quickly. The first one's employee stock options, and the basic point is if we move towards a knowledge-based world, and people are clever and they know they're integral to value creation, they're going to want the upside. And the primary way to do that is via equity, and the most efficient way, or a efficient way to do that, is via options. And our basic point there is that we should really, I think most boards of directors and frankly most managers have no idea what they're doing when they grant these options. They have no idea what the values are, what the issues are, and so on and so forth. Our basic point as an analyst, that should be treated as a contingent liability and an ongoing cost and built into your frameworks. I think the more interesting dimension is real options. And real option, again, it's a financial analog. It's the right but not the obligation for a company to pursue a value-creating activity or initiative. For real options to be relevant for a company, I think three things have to be in place. Number one, you have to have a smart management team. So these are sort of folks that think about adaptivity and creativity and so on and so forth. Typically market leaders that see the best opportunities. And most importantly, this is a central feature, is a heightened level of uncertainty. So the basic point is, as markets become more uncertain, and literally some companies are defining themselves on the fly, how do you value that uncertainty? And options become a very powerful way to do that. So in our argument, our thinking is that for a lot of companies, especially startup companies, are best thought of as a set of existing businesses, many of which have something, plus a portfolio of real options. These may not pass the net present value sniff test, but there's option value that we have to think about. Reasonable people will disagree about what that value should be, but we think it's absolutely something that should be taken into consideration. I'll add, this is unsolicited, I'll add one more sidebar on this, and that I think there was a really interesting series of articles in the journal. December 28th was a market efficiency debate between Bert Malkiel and Andre Schleifer. And they end up, they're two academics, they sort of end up being in the same little camp. They're technical arguments about arbitrage and such. But about a week ago, 10 days ago, George Soros wrote an letter, and he said, both the guys are missing the boat. And there's this concept he calls reflexivity. Fundamentals, we all know, affect price, and stock prices, that's fine. Soros' point is stock price often affects fundamentals as well. And I think what we've seen in the last 12, 18 months is reflexivity on steroids. In other words, the company's ability to literally finance their real option was a function of their stock price. So it was a self-fulfilling prophecy. The price was up, options could be identified and funded. When the stock goes down, even if those options conceptually exist, they can't be funded. So they basically get marked to zero. So it's almost like saying, I'll give you $2 million if you give me $1 million, but if you can't come up with $1 million, the proposition is worth nothing to you. And I think that's what we're seeing in markets out there. So at the end of the day, the dust is settling, and there are companies that have very interesting option values, potential options, and it's going to be incumbent on the capital markets to come back and facilitate the ability to finance those. And you're starting to see a little life in the junk bond market and such, but we'll see.
Any other questions or comments? If not, I'd like to thank you all for coming. Just in wrapping up, I should mention one comment that Dick made to me a week ago as we were talking and preparing for today's meeting. I think he mentioned to me that as an economist, there was a line that impressed him once that, I hope I'm quoting it correctly, Dick, that economists were invented to make the weatherman look accurate. But I think in today's discussion is showing up two very able, very perceptive economists who will run rings around the weatherman for many years to come. So thank you all for coming.